Our analysts are always on a mission to make great stock picks for our community. But rarely do we get to dive into their minds and learn more about them and what drives them to make these choices. What really makes them tick? This is Analyst Analysis. Welcome to another episode of Analyst Analysis. Today we are joined by John Rotonti, who's been a fool since 2014. John has been very vocal about his focus on high-performing stocks that he believes have little to no competition in their industry. In today's discussion, we'll be chatting about what kind of companies he believes currently hold that status, and most importantly, which company has the potential to rise in the ranks and become as valuable as some of the biggest players in the public market today. It's going to be an amazing talk, and I'm so excited for you all to hear it. And if you enjoyed this conversation as well, please make sure to leave a like on this video so we know to keep this series going. And leave any suggestions for future videos down in the comments, whether that be an analyst or just an expert in a particular industry. Anything goes. Now please enjoy my chat with John Rotonti. So thank you so much, John, for coming and talking with us just for a little bit here. Really, the whole point of this is just kind of to get the idea behind your investment style and what kind of goes into your picks and what leads you to those decisions that you make. So first, I just love to get a little bit of background on yourself. Just tell us a little bit about yourself, brag a little bit, let us know who you are.
Kevin, thanks for speaking with me. I'm excited to talk about investing with you. I'm a senior analyst at the Motley Fool. I've been at the Motley Fool for 7.5 years, and I'm also the head of investor training and development. And I can talk about that role in more detail if you want. And then I'm the co-host of a few shows on Motley Fool Live.
Yeah, please do. Go into that role.
So as the head of investor training and development, I think I have maybe 3 or 4 primary responsibilities. One is I help to train all of our new analysts. So our chief of operations of U.S. investing team, Ron Gross, runs the IDP program, the investor development program. But I teach a lot of the classes, and I also hold office hours once a week for our analysts in training, for our investors in training. And then, so that's the first thing. I help to teach all of our new analysts. I also, second thing is I serve as a resource for our entire investing team. So I have a library of data on companies that I've been building for over 20 years. And so if someone needs information on a particular company or a particular industry, or help building a model, or help networking in a particular industry, I can probably help with that. And then if I don't have the answer or the information myself, I can usually find it, or I will try to find it. And then the third thing I do is I'm in charge of, I don't know if I'm officially in charge, but I try to do investor outreach for our team. And so I reach out to other leading investors that we admire, and I try to bring them to give lectures to our team, to give presentations, lectures, discussions for our team. And sometimes I'll bring in these outside investors on an individual basis, and then sometimes I'll bring them as a panel, a group of 3 or 4, and we'll have like a roundtable discussion with them. And we try to do those once a quarter. And so yeah, those 3 things. I help to train our new analysts. I serve as a resource to our entire investing team, whether it's a junior analyst or a senior analyst, and then I do investor outreach.
So what I would love to talk about is kind of what is something that really makes a stock stick out to you or a company, and what makes you want to put a little bit of your own funds, not so much really a recommendation, but really just personally yourself, putting your own capital into it. What kind of qualities are you looking for when you do that?
So there's a difference between a business and a stock, and we'll get into that. But when I'm trying to identify businesses, what I'm looking for are the very best growing businesses in the world. And I don't just mean pretty good. I mean the very best, what I believe to be the very best growing businesses in the world. And to be the very best, the business has already achieved scale. So these are not companies that are waiting to scale, hoping to scale, or in the process of scaling. They've already achieved scale. They are, I mentioned growing. I will not invest in a business that is not growing. Now, does not have to be hyper growth, doesn't have to be superlative growth, but I am looking for good organic revenue growth. And by good, let's say high single digits as a minimum. So I'm looking for strong, long duration, durable growth companies. What I mean by long duration, durable growth is they may not be the fastest growers, but I think they have a moderate rate of growth that I think they can maintain for a long period of time. So these long duration, moderate growers. So these are businesses that have already achieved scale. They are growing at attractive organic rates. They have incredibly strong balance sheets, largely with net cash positions. What I mean by that is they have more cash than debt on their balance sheets. They are highly profitable. They are highly free cash flow generative. And in a lot of cases, they operate in oligopolies, duopolies, or monopolies. They have limited competition, very high barriers to entry, and what they do is extremely hard to replicate, or at least I believe that it is. This is all my opinion, right? I could be wrong, and I am wrong, but this is based on my research. This is the opinion that I come to, is that these businesses have achieved massive scale. They have limited competition, are protected by high barriers to entry. They're extremely resilient and adaptable. They are growing. I think they can grow for a long period of time. They're highly profitable. They have high or rising returns on invested capital, and they just generate more free cash flow than they know what to do with, really. And then companies that have these qualities, Kevin, are run by great management teams. It's really, for the most part, there may be some exceptions in there where you get surprised by a management team that's less than great. But if a company has achieved this greatness that I'm looking for, in most cases, they're run by extremely good management teams. And so the four things that I look for in a management team are, I look for a management team that is extremely capable. They have to be good at what they do. Compassionate. They need to treat people and the planet well. Candid. I want them to be transparent with me. I don't only want them to talk about their wins, but also their losses, also the mistakes they make and how they plan to fix those. And then committed. Just committed to their mission, committed to their purpose, committed to doing what's right by all stakeholders, committed to innovation, committed to adaptation, all of these things. So I call them the 4 C's: capable, candid, committed, and compassionate.
That's awesome. So what are some companies that you can think of off the top of your head that sort of fit that bill?
The best, it's not hard, right, to identify the best companies in the world. What is hard is to find out when those are good stocks. That's why I said there's a difference between the best businesses and the best stocks. But I'll just give you my largest positions are Google and Microsoft. I think they have all of the qualities that I just mentioned. Every single one of them. They tick all of the boxes. And there's, in the semiconductor world, there's ASML, a Dutch company. It has a 100% global market share, making the machines that make the most advanced semiconductors in the world. They're the only company in the world that has these, they're called extreme ultraviolet lithography machines. So they have 100% market share. But that's an earned monopoly. They earned that monopoly because they had the capacity to suffer for 30 years. That's how long it took them to invest in this technology, which is really at the cutting edge of physics. There were 2 other companies that tried to do what they were doing and dropped out. They didn't have that capacity to suffer for 30 years. And so this company ASML, they put in the blood, sweat, and tears for decades to get to where they are today. Taiwan Semiconductor is the leading semiconductor fabrication company in the world. They have 90% market share for leading edge. The most advanced semiconductors in the world are made by Taiwan Semiconductor. And so once again, these are companies that have not only achieved massive scale, Google, Microsoft, Taiwan Semiconductor, ASML, but they have limited competition. And they've earned these positions by investing in innovation, investing in adaptation, and being really good at both operations and capital allocation over a long period of time. So they have limited competition. And they generate amazing business economics. The stock part of it is, okay, so you've identified these businesses. When is the stock trading at an attractive value? And so that's where valuation comes into it, and there's lots of different tools we use to see if we think a stock is attractively valued. But basically what I'm looking for, Kevin, is I'm looking to find these great businesses when the market is not expecting a lot from them. And so the expectations for future growth and future profits from the company are really low. So I want a gap between the greatness in the business and what I estimate to be the intrinsic value, and that's an estimate. And I'll come up with a wide range of estimates for what I think is the intrinsic value of a business. The wider the range, so I can come up with a narrower range of estimated intrinsic value if the range of outcomes for that business is narrow, if it's a predictable type of business. But if the range of outcomes for that business is wide, then estimating valuation is really hard. Estimating intrinsic value is really hard. And so my range of possible values is going to be wider. But I want to find a stock when the expectations priced into that stock for the future of that company are very, very low. So I want to buy greatness when it's attractively priced, when the expectations are low. And it's not easy. It's fun, but it's not easy. So I said that the greatest businesses on earth are pretty easy to identify, and I think that's right. But I want to walk that back a little, because the question is not just what is great today. The question is what is going to be able to maintain that greatness, and that's when it gets hard, right? Is what they're doing so hard to replicate? Are the barriers to entry so hard? Is the management team so good at finding that next big growth opportunity that the company that I think is great today is going to be great 10, 20, or 30 years from now? So it's the endurance, the durability, the sustainability of that greatness. And then I want to buy that when it's attractively priced. Not easy.
Perfect formula, right? And you just got to predict the future.
Right, but because it's not easy, Kevin, so you asked me about my personal investing, I only buy stocks 2 or 3 times a year on average, literally. And I only open up my brokerage account when I'm buying a stock, unless I'm selling a stock, but I sell even more rarely than I buy. And so if I'm only buying stocks on average 2 or 3 times a year, I only open up my brokerage account 2 or 3 times a year. I open up my account so infrequently, I literally forget my password. I don't even know it. I don't know what my stocks are doing on a day-to-day basis. I just don't know what they're doing. Now, I'll see something on CNBC, or I'll see something on another financial media site that I'm reading, or one of my colleagues will mention, oh, so-and-so stock is up so much today, or so-and-so stock is down so much today. And so I'm pretty aware of what's happening in the market, and with my stocks in particular, especially my larger positions. But there are without a doubt days when some of my smaller positions have really big moves, and I have no clue. It's just zero clue. Logging in and out of my account is not something I ever do unless I'm making a buy or sell, and I almost never make buys or sells. I think the opportunities for the type of investor I am, the opportunities are few and far between. I don't want to just buy something that's pretty good. I want to buy something that's great when I'm getting a really good deal on it. And that doesn't happen every day.
So kind of going off of that very infrequent purchase, when was the last time you bought?
The last stock that I bought has been, so far, a disaster. An epic disaster. So I own 45 stocks-ish. In my portfolio, I only have 2 stocks that are down, meaning losing money right now. And one of them is down like 2%, so it's basically flat. I don't consider that. And then I have one. So the stock is Peloton. Ticker
Oh, no.
Yeah, ticker PTON. And it's a company that I was really bullish on until recently. And so I had some stock, and I bought it. I don't know, the initial block of shares I bought were probably in the $60 price range. Okay. I don't even know. Like I said, I don't know the price I bought, but it's probably in the low 60s. And then the stock ran up during the pandemic, just ran up. And then it fell about a month and a half ago to 82. And at that point in time, it was at a 52-week low, and the stock had fallen about 50% from its peak during the pandemic, okay? From its all-time high. It had fallen about 50% down to $82 per share. And I added to my position at 82, and I think now the stock is close to 40. So it's got cut. So my most recent stock purchase was about a month or two ago, and it's got cut in half. And I don't know what I'm gonna do about it yet. But right now I'm just holding tight and crossing my fingers. And if I made a mistake, so there was probably a lot of mistakes made in there, but I would say the biggest mistake I made, Kevin, and this is something I'd like to drill home for anyone that's trying to learn from the mistakes that I've made, is position sizing. And so the mistake I made with Peloton was making it too large of a position size. I don't know why I did that, Kevin, because my entire investing framework is based on putting my largest portfolio weightings into these super resilient businesses I talked to at the top of the program. The best businesses in the world that meet all of my checklists or most of my checks, have already achieved scale, have massive balance sheets, are massively profitable, massive free cash flow generation, high or rising returns on invested capital. Peloton doesn't have any of that, Kevin. None of that. And so I don't avoid putting those types of stocks in my portfolio. I just make them smaller positions, sometimes tiny positions, Kevin. So I put large positions or larger positions in what I believe to be the best businesses in the world. Those that have already achieved scale, have very limited competition, you know the list. And then I take small positions in these emerging compounders, right? By emerging, I mean, these are not the best businesses in the world yet. Not even close. These are companies that the Motley Fool loves and that I love. We think they can become the best businesses in the world, Kevin, right? Like enterprise software companies and stuff like that. Genomics companies, other biotech companies. These companies are earlier in their life cycle, their corporate life cycle. They have not achieved scale yet in a lot of cases. They are facing a lot of competition. They are growing at superlative rates, but a lot of times they are non-earning and cash burning. So they had not achieved profitability. They aren't generating real, true free cash flow. They don't have high or rising returns on invested capital yet. I love investing in those businesses because those could be the 10 baggers or the 100 baggers or the 1,000 baggers the Motley Fool is so well known for. I just take tiny positions in them. With Peloton, I blew up my framework. It deserved a tiny or small position, and I made it a large position. And that's on me, and I'm living through it.
Yeah, I've definitely been there where I'm like, well, it can't go any lower than this. Just buy it.
It's exactly where I was when it was at 82. I thought I was stealing it, Kevin, at 82, and it's now 42.
Yeah, it's definitely tugs on the heartstrings.
It does a bit, but it's a lesson that I'm learning, and hopefully by sharing my story, others can learn from it as well.
I want to give you one lightning fire round question before we end things. What is a company that you think is kind of in that early stage of the life cycle that you think has a potential to be one of those much larger companies that you usually look out for right now?
Ones that
I know that's a little bit difficult.
No. I own them. I include them in my portfolio. So I own a lot of businesses that sell software as a service, right? So SaaS, software as a service, is a business model. It's a way of selling software on a subscription ratable basis, basically on a recurring revenue basis. And so in that space, I own, and there are various types of software that are sold, but in that space, I own Shopify, The Trade Desk, HubSpot, Paycom, and a few others, smaller positions. But if to answer your question, if you were to ask me what company do I think has the potential to become like the next FANG, right? FANG, stood for Facebook, Amazon, Alphabet, Netflix, or Facebook, Apple, Amazon, Netflix, Google. Now Facebook changed its name to Meta, so we don't use FANG anymore. But if I had to pick like what could be the next FANG, I would pick Shopify, run by an amazing CEO in Toby Lutke. He's trying to build a 100-year company. And it has an almost unbounded growth opportunity for this reason. We talk about total addressable market, and a lot of companies like overplay, I think, their TAMs and stuff like that. But with Shopify, they are facilitating the creation of and success of entrepreneurship in this country, and then eventually around the world as they expand. So they are facilitating the startup, the creation of new small businesses. There's almost no end in sight to that. You can't put a number on that TAM. You can measure the total addressable market, or TAM, of small business in the US today, existing small businesses, but that's not what they're going after. They're also facilitating the creation of brand new businesses. And for that reason, they have an almost unbounded growth opportunity. So I would say that's one reason I put Shopify in that category. There's several other reasons. Amazing management. They layer on additional products, like we're seeing with payments, like we're seeing with fulfillment and other things they are doing to their core business. So if I had to pick one company to become the next sort of mega cap $1 trillion plus business 10 plus years from now, Shopify is at the top of my list, and number two is sort of not close right now. There's a gap between Shopify and all of the others. Lots of other great ones, but Shopify is at the top of my list.
Awesome. Well, thank you so much. I appreciate you taking time out of your busy schedule and having a chat. It's been awesome.
This has been so much fun. I hope we can do it again. Thank you, Kevin.